Hey, it's Jim, and this is level 3 of the CFA program, the topic on ethics and professional standards, and the super long reading on guidance for standards 1 through 7. We, of course, have chopped the big reading into 7 different slide decks and recordings. So today we'll go ahead and talk about standard 2, the integrity of capital markets, which has 2 components. And I think it's interesting that right before the introduction and the section on each of these standards, there's a list of highlights. And so the highlights for material non-public information, which are great sources of exam questions, are material information, non-public information, the Mosaic theory, social media, the use of industry experts, and investment research reports. So let's go ahead and think about those 6 areas as we go through this first part of material non-public information. Here are the LOSs. They're the same for all 7 of the standards. And here it is. Members and candidates who possess material non-public information that could affect the value of an investment must not act or, and this is why I'm reading this, or cause others to act. And so an obvious exam question is to act on this material non-public information, and that's an obvious violation. But cause others to act could be a little bit more subtle. Now, an obvious outcome is for the member or the candidate to say something like, oh, here's my husband or wife. Why don't you go over there and buy shares of this particular stock because I have this information that's private and I know it's going to increase the value of those shares. Well, that's kind of a direct and obvious notion, but there are other subtleties here that we'll see in just a few minutes. So let's go ahead and start with one of the Institute's questions. This is one from the end of the reading. So here we have an analyst assisting his firm with a secondary offering for Bright Ideas Lamp Company. All right, so we have a telephone conference call. And during that conference call, this analyst is advised that the company's earnings projections for the next year have significantly dropped. All right, so what does that mean? That sounds an awful lot like it's probably material, it's probably non-public. We'll get to those specific definitions here in just a second. And so this sounds like the definition of exactly what this standard is referring to. All right, so during this conference call, several of the firm's salespeople and portfolio managers walk in and out of Peter's office. So they are aware of this drop in projected earnings for Bright Ideas. All right, so what was confined to just the individuals in the conference call now has expanded to include some people in this analyst's firm. All right, so what do they do with this? Well, what should they have done with this? Well, I'm not really sure exactly that the Institute would write a question like this, but maybe Peter could require anybody who walks into his office has to have earplugs in and maybe an eye patch or something so they can't see or hear any potential material or non-public information. All right, so we don't like that just initially. So then what happens? The salespeople trade the stock of the company on behalf of the firm's clients. Well, we probably don't like that at all. And other firm personnel trade the stock in a proprietary account and in their personal account. So we don't like any of this. But look at the question here. Has Peter violated the standard? We don't hear anything about Peter trading the stock. We don't hear anything about Peter doing something for his clients. We don't hear anything about that. So you see how clever the Institute is. Clearly, the other people have violated this standard. But has Peter? And of course Peter did because, and let me go back here just quickly, right? Or cause others to act. So this is a little bit more of a subtlety that I was talking about before. He failed to prevent the transfer and misuse of material non-public information. So there should have been barriers to prevent that communication. Barriers, think of eye patches and earplugs. So let's go ahead and get into the meat of this particular standard. What constitutes material information? So this is one of those highlights. Yeah. If its disclosure would affect a security's price, or if any reasonable, prudent investor would want that information before taking investment action. I can't help but think about my sports analogies that I give all the time. This is why the NBA and the NFL are really big on disclosing player injuries. So they say something like, "Oh, Patrick Mahomes is very likely to play in this game," or "He's not too terribly likely to play in this game," or "He's out," or "It's a game time decision." And they have specific terms for all that because anybody who's interested in betting on the game would want to know if Patrick Mahomes is playing or not. So it's the same thing here inside of this material information. So here's just a short list of some examples, and you could come up with many more of these. What I'll do is I'll reference you back to our corporate finance readings that we've had, level 1, level 2, and now level 3. Think about anything, any topic, any LOS that goes into those corporate finance, like dividend policy, right? Mergers and acquisitions. I mean, anything that's in there, that probably would be a good source of a material information exam question. All right, so then what's non-public information? And you might be tempted to say something like, "Oh, well, anything that's not out there." Well, you have to be concerned about how that information goes from the entity. Let's say it's a corporation. How is that information, how is that disseminated to the public? I mean, think about it. Suppose that I'm Jim's Concrete Company and I know that I'm going to be taken over by Bob's Concrete Company. And Jim, me, and Bob, we're the only two people that know about this. And I go out the back office door and I yell on my megaphone. I say, "Hey, Bob's company is taking me over at a 58% premium." So I shouted it out to the public, but suppose that my building is in a farm and there are just a bunch of cows out there. That's probably not what the Institute has in mind for dissemination of non-public information. So in the question stem, look for some signals that it has been widely distributed. Press release, that's an obvious one. Any kind of Wall Street Journal or New York Times articles, some kind of an online platform. And here's where it gets interesting. Remember, one of these highlights is social media. So how do you do this? Well, I don't really know anything about social media. I've said this to you before, but let's suppose I have an Instagram account with 10 clients and I post there, "Okay, Jim's Concrete Company is being taken over." Well, that's just 10. That doesn't sound like that this was a widely distributed. All right, so look at that second arrow point. Yeah, a wide reach before it can be considered public. There's that term that I love, reasonable, right? Is it reasonable to think that it's public when I shout on my megaphone? Probably not. But if I put it on a web page and I talk to a Wall Street Journal journalist, well, that sounds an awful lot like it probably is. Now, look at that third arrow point. Here's another subtlety that I was talking about. So when we're visiting with these companies as an analyst and we're visiting with the executive leadership team or the board of directors or whoever it is, that source company, we're probably going to get some kind of information. Some of it might be public. Some of it might be non-public. Some of it might be partially public. That's my term. I'm not sure if that is appropriate. But look, we're going to get this information. And if we want to do and perform our due diligence, we can use that information to kind of give us a general sense. So look at the arrow point there at the bottom. Within the confines of the business agreement between the two parties, however, we can't trade on this information or cause others to trade. So this becomes kind of part of that Mosaic theory that was one of those highlights that leads us into this next slide here. So what is the Institute training us to do? What is our life experience training us to do as good financial analysts? Well, pick all this information, find what's relevant, find what's irrelevant. Sometimes we're going to have publicly available. Sometimes we're going to have non-publicly available. But this is really important here. We need to make certain that we do not violate the standard by just using, look at the top right up there, public and non-public, non-material sources and information. So we need to be concerned about if this comes directly from the source company or indirectly from the source company. So we need to just be very careful here, right? The Institute, they want us to be super smart. They want us to make all these great decisions for our clients. We'll have a standard here in just a few recordings where we have, duties to our clients. What is our duty to our client? That duty is to perform due diligence and to be the best representatives and stewards of their capital. And that means going out and figuring all this stuff out. Now, a point of emphasis in the reading is very clearly that, all right, you do all this work, but let's go ahead and make sure that we have records of it so that we don't have any appearance of the use of material, non-public information. I say this pretty regularly. Institute, they want us to monitor all the time. So this is kind of part of that umbrella of monitoring that we want to make sure that we keep good records. And we have these records, right at our fingertips so that we can show proof that, hey, you know what? I did all this work and any reasonable person would have come up with this. And we put all these pieces of the puzzle together and, oh my gosh, there's a beautiful picture of the beach and now I can do something with it. All right, social media. Yeah, this is what I was emphasizing just earlier. Look at the very bottom bolded we have. Reaches all clients or is open to the investing public. Social media must not benefit a few at the expense of the majority. And, so the Institute is very keen on the simple fact that some social media is available to everybody out there instantaneously, but then there are certain components of social media that require memberships and they have limitations. And so you can't just send it to, what did I say earlier? You can't just send it out to your 10 best clients. You can send it out to simultaneously your 10 best clients and then the rest of the world simultaneously. That's a key element there. Now, I say this regularly in the recordings that I've made, level 1, level 2, and now level 3, that the Institute is not requiring us to know everything that's possible out there to know about a company or a security or a particular model. So, of course, they say, look, if you don't know this, you may know, we might know the breadth, but we don't know the depth. So there's some experts over there. So, of course, we're going to hire those people over there to say, hey, will you come into our office and tell me about this? Maybe it's like a machine learning trading model. Yeah, sure. Of course, we want to know about this and we can even pay them. All right. So we're allowed to consult the experts and we're allowed to compensate them. But we cannot go to the expert over there and say, hey, can we pay you for this private information? Or can we give you Super Bowl tickets for this private information? And so, the solution to this is in these agreements, the disclosure agreements that lots of parties sign. Think of this disclosure agreement. Go ahead and read the newspaper every day. Did Tom Brady and his wife, did they sign a prenuptial agreement before they got married and then divorced, et cetera, et cetera? That's kind of fun. It's we like reading about this. Although personally, I'm always sad when I read about anybody getting a divorce. But clearly, this is the exact same thing. We want to make certain that whatever's going on there with the expert is consistent with what the Institute wants us to do. Now, what are we going to do as good investment research analysts who produce a report, right? And so we talk about this and we talk with this expert over there. Boy, what if we talk to that expert, we compensate that expert, and then we put together this kind of a research report and we're really, really popular, every day I'm on TV, I'm doing all this time. I will say this on a personal level. One of my favorite students of, maybe a decade or so ago, he shows up regularly on a financial news program, and I'm always so proud to watch him there. And it's so much fun. But, is he a renowned analyst? Maybe. So we need to be concerned about, boy, is this material that would cause significant market movement? So let's go through a handful of these recommended procedures here. Achieve public dissemination. I mean, this makes perfect sense. How do we do this? we're going to encourage that source company to make this information public. So think about it. We have this conference call and we learn a bunch of stuff, whether it's dividends or mergers or capital structure, whatever that information is. And the Institute wants us to say something like, look, I have this information. I'm not going to do anything with it because it's material and it's non-public, because I'm bound by the rules and regulations of the Institute. But boy, you'd make my life a lot easier if you just went out and make certain that this is publicly available. Sometimes it's possible. Most firms want to get good news out there as soon as possible. You might have to prompt them if it's bad news, but there's this concept in economics and finance theory called the early resolution of uncertainty. So that even if you have bad news, shareholders would rather have the bad news today rather than next week. So there's all sorts of good reasons to encourage that source company to make good news and bad news publicly available as soon as possible. Well, sometimes you can't do this. You can't convince them, or there might be some other kinds of legal restrictions. And so, of course, what does the Institute want you to do? Go to the compliance department and say something like, all right, we have to wait. Let's make sure that we have this material, non-public information. Here it is in a box. I'm putting it over there. Nobody has access to it. So what is the compliance department going to do? And we'll learn about this in just a few slides. We need to have a procedure, right? We need to say something like, all right, when this happens, we do this and this and this. Yeah, here we go. Adopt compliance procedures. So that's my whole example of putting it in a box over there. Nobody can misuse. There's a bolded word there. Adopt disclosure procedures. There's my X, Y, and Z. Issue press releases. We want to do this immediately. And then 4 and 5 are kind of related here. Interdepartmental communications and firewalls. I think I've used this example before, so forgive me for going back to my childhood. You remember in that great episode of the Flintstones when Fred and Barney had a fight and they erected a wall in between their two properties. And so there's the firewall. They couldn't see each other. They couldn't talk to each other. Their kids couldn't play with each other. Their dinosaur pets couldn't talk to each other. So that was what I think of, elements of a firewall, and then interdepartmental communications. This is part of those formal procedures that the compliance department and others, maybe the chief risk officer, is going to come up with. And then here's the physical separation. So there's the Barney and Fred wall. How about some other recommended procedures, right? We want to avoid an overlap. We want to make sure that the investment banking people are over there, and we want to make sure that the corporate people are over there. And then if we have some other people, maybe it's the sales people over there, maybe it's research people over there, maybe it's real estate over there, and alternative investments over there. Think about erecting a Fred and Barney wall between and among all of those departments. Establish a reporting system. This goes back to what the Institute likes us to do: monitor, disclose, report, all that stuff. Limit the personal trading by employees. That makes sense. And there we go. Maintain a record. We can't be surprised that the Institute is interested on that. So let's conclude Standard 2A with one of our questions here. We have a portfolio manager specializing in tech stocks who wants deeper insights into the sector, right? Who is an expert on artificial intelligence and machine learning? I mean, we could try to become experts, but let's go ahead and hire an industry expert. Let's go ahead and pay that expert for his time. All right, so this manager leaves the session better informed and enhances research reports and conclusions. All right, so which of these actions would be a violation? I'm sorry, would this portfolio manager's actions violate the material non-public information component of this standard? So notice we have 2 yeses and a no here. Once again, I'm not sure that I can give you any advice about what the mindset is of the Institute. If they give you 2 yeses, you probably are led to think that, oh yeah, yes is probably one of the correct answers. No. But don't be tempted to fall into that trap. All right, so what about this? Yes, because she's using the knowledge of the expert to enhance her research. Well, we just saw this a slide or two ago, right? We're allowed to consult the experts, and we're allowed to pay for them. No, because she was allowed to hire. Yeah, that makes sense, right? Part B, that's a good one. Well, how about 3? Yes, because she compensated for the insider information. Maybe we need a little bit more detail. Maybe we need a comma there, and we could have something after that that might lead to that. But I think in general, what we're saying here is this portfolio manager, of course, is probably not violated. All right, how about market manipulation? Here's the definition. Must not engage in practices that distort prices or artificially inflate trading volume with the intent to mislead. That's the Institute's way of saying faking out. So let's go ahead and start with one of these questions from the Institute. All right, so here we are. President of local bank hired the bank's market maker, Vogt, to seek a merger partner. All right, so this makes sense. Local is currently listed on an exchange, has not reported that it is seeking these strategic alternatives. All right, so there's this signal about private information, non-public information. Let's see. The market makers discussed the possibility of a merger with several firms, but they have all decided to wait until the next period's financial data are available. All right. Now, we talked to these potential buyers, but they believe the results will be worse than prior periods. All right, so there's an expectation, right? That's based on maybe due diligence, maybe expert opinion, whatever that is. But Pietro wants to increase the likelihood of structuring a merger deal quickly. Which of the following would most likely be a violation? All right, so make sure you do this. Make sure you read most likely or least likely on the exam. All right, so what are we saying here? We could instruct the local bank to issue a press release announcing that it has retained the market maker to find a merger partner. All right, well, that sounds like that's consistent with what we were talking about, encouraging, well, in this case, the source company, it's kind of the same person here. All right, place a buy order for 2,000 shares, 4 times the average weekly volume for his personal account. Well, that doesn't sound anything like anything that the Institute would be happy with. How about C? After confirming with the CFO, instruct local to issue a press release reaffirming the firm's prior announced earnings guidance for the full fiscal year. Well, this sounds reasonable that we're releasing some kind of information. Maybe it's not non-public information. Maybe it's not even material information, but that sounds okay. Yeah. So, we don't want to place that order for 2,000. Now, this is what I found really fascinating here. As a test maker during my entire adult life, I was wondering that shouldn't maybe part answer B would be better if it said something like Pietro should short these shares, 2,000 shares. I think it works either way. Go back to the question stem. To increase the likelihood of structuring a merger deal. So if these potential firms out there who are looking at local bank as a takeover candidate, would they be more tempted to engage in that discussion if the price was lower, if we use my example of short these shares, or if the price were higher? And so the way this question stem, it's really clever. The Institute is clever, and we're clever in trying to come up with these question stems. So if you have several partners and you see the price rising, one is probably going to jump in quickly and say, you know what, I want to get in there because they have private information, right? Price is going up, so something good must be happening. So either way, look for market manipulation on the exam for trading activity. In this case, it's volume, or price movements, either upwards or downwards. All right, so what is market manipulation? Look at what we have in bolded there. Deceive market participants, erodes investor confidence, distorts information signals. Remember all that time we spent in our corporate finance discussions about the signaling value of dividends, the signaling value of issuing a bond, the signaling value of stock repurchases, the signaling value of using your own company stock to take over another company. All right, so this erodes and distorts those signals. So here are the two highlights in this part B of Standard 2, information-based and transaction-based. We just did maybe a combination of both of those in that previous problem here. So information-based manipulation, this is clearly where we're trying to distribute false or misleading information. This is kind of like faking out the public. And there's the example of pump and dump. If you're regular readers of the Wall Street Journal, you know how you pump up the price, right? We go out on social media and say, oh my gosh, look at all this. And the stock price goes up. And then, well, we bought before we did all that. And then we sell it after the price rises there. So social media networks. So this is a little combination of the important concepts here in Part B as they were back in Part A. Transaction-based manipulation. What the Institute does is give an example of two people. You know, like me and my wife. Like what we could do is we could just buy and sell shares of the same stock to and from each other, and we could do this over a period of like 5 minutes, or we could do it over a period of 5 days, whatever it is. You know, what that indicates is some big level of trading activity. You know, the Institute says something like, you're probably not going to be able to do this with Johnson & Johnson or Procter & Gamble or Hershey Foods because, you know, they have massive trading on the floor of the New York Stock Exchange. But a company like, what did I say earlier, Jim's Concrete Company, we need to be more careful about this. Now look at the very bottom purple box there. Legitimate trading strategies. These are not a violation, but what does the Institute want us to do? If we have a proprietary trading model, right, or we have this strategy, let's just go ahead and keep track of the model, keep track of our records, monitor, do all that kind of stuff. But look at the bottom right. Yes, intent. That's the clear indication of a violation. Let's take a look at a final question here, or the CEO of a futures exchange, right? We hold the designation, right? Comma CFA, introduces a new equity index futures contract in an attempt to attract individuals significant discounts on its trading fees. Now, that sounds okay, right? Anybody can offer a discount. We can say, you know, hey, it's on sale, right? But now we got this next paragraph here. Firms must agree to a minimum trading volume. All right, so now we're imposing some kind of a restriction for 6 months. Wow, all right. Demonstrate consistently large liquidity. Well, let me just go back here. What did I say to you before? What was that bolded word at the bottom right? Intent. Oh, that sounds like something that we don't like at all. That will attract new brokers and retail traders are. So Reynolds actions in conflict. So notice here we have 2 no's and a yes. All right, so no, Reynolds is allowed to offer discounts. I mean, that's true. They engage on the exchange. Those people are in violation. Well, they might be if they agree to all this and they know our intent and they can benefit from that trading. They might be. We don't have enough information in the question stem to make that conclusion, but clearly we're attempting to mislead. So yeah, C sounds to be like the reasonable, accurate and correct example. And by the way, my advice is to make certain that you read all 3 of the answer choices on the exam, even if you're convinced that A is the correct answer. Just make sure you read them because there might be something in theirs. All right, so what I want you to do is the same thing I said at the end of the professionalism standard, and I'm going to ask you to do this after each of the 7 standards. Go to those 40 or so questions that are at the end of this reading, and I want you just to casually go through them, read the choices, read the answers. So I want you to do this 7 times casually. I mean, just take 10 minutes or so now to do it, because at the end, after we do standard 7, I'm going to ask you to take an hour to do all of those. And then by the end of all of these slide decks and recordings, you should be locked into all of the highlights. Whoops, I went one too far. So hey, thanks for watching, and have a great day, and good luck studying.